All right, well, with stocks at all-time highs, one can always ask the question, how do you navigate your investment portfolio? And joining us for a deeper market conversation this morning is Kyle Taylor. He's a wealth advisor and portfolio manager at TriDelta Private Wealth. Kyle, it's nice to see you. The fact that there has been this steady momentum for North American equities, what's been your reaction to that?
Well, we think that the second quarter earnings season will be an important determinant on the remainder of the year. You mentioned off the top that valuations are elevated, the indices are at all-time highs, and with that comes an expectation of potentially lower returns over the long term, because entry points matter, of course. The TSX is trading 18 times earnings, still cheaper than the US. The S&P 500 is at 22 times earnings. Still think that there could be bright spots for the S&P 500. You mentioned there's AI momentum with tech. The weaker US dollar could play a role in driving some near-term boost for international-oriented companies. Apple, for example, makes up over 60% of their annual revenues abroad. Convert that back to US dollars, that could provide a near-term boost. But I think for Canada to move higher the second half of the year, I think you need more participation from some of the energy names. The financials are quite elevated. A lot of the gold stocks and material stocks are also at highs. And in order to have the TSX move higher generally, I think you need more participation from other sectors. Yeah,
just taking a fresh look here on my Bloomberg terminal, energy up about 2% for the year, so obviously lagging the TSX itself. I know a lot of investors love to get a good deal and buy when there's, perhaps a cheaper valuation on a company. I was, though, because we're at all-time highs, looking this morning at what history tells us about investing at all-time highs. There's all sorts of online stats around what happens with the S&P historically. There are still some good cases to be made for stocks, 3 years, 5 years out to be higher than they are, even once you've hit all-time highs. So maybe that itself is not necessarily the catalyst to be cautious, but I guess because valuations are higher, and you talked about sector participation being one thing you're watching, are there any themes that you would be watching that would sort of help to guide the market on whether the mood is positive or negative going forward?
Well, I think we'll want to see some positive developments with second quarter earnings reports. I mean, we'd be much more comfortable with valuations where they are if earnings continue to be 12+%. But at 7 or less percent, then you have to be a bit more conscious of what the underlying fundamentals of the stock are. It doesn't mean that stocks can't continue to push higher. We know that's been the case time and time again, especially with some of those big tech names. But in terms of themes, one of the tech theme that I'll mention is looking a bit more on the periphery of the AI theme, less on the chip manufacturers like TSM and NVIDIA, which are quite expensive.
Yeah.
There's names out there that still stand to benefit from AI that that are showing a more reasonable valuation.
And you want to tell us about today?
Five9 would be one. It's an American company. They are migrating human chatbot or chat interfaces more towards an AI cloud-based solution. They're an example. Dynatrace is another American name where they are looking to find operational efficiencies and actually quantify how AI is helping businesses. So that's a company that maybe other names are looking to partner with.
It's a fascinating time, and it's great. It sort of tells us about all these different interesting technology stories. Thank you for sharing those ones. The other thing, though, is people have stocks in their portfolio. Oftentimes they have bonds in their portfolio. Oftentimes they're looking for income. Maybe they're looking for dividend plays as well. So you're thinking about sort of holistically everything and where can I get income. So how do you approach that part of the story?
Well, I think you need to appreciate the fact that interest rates are obviously lower, and the expectation is that they will continue to trend lower in the remainder of 2025 and into 2026. I mean, you can get a money market fund at 2.5%. You can get a GIC in kind of anywhere in the 3% range. A lot of investors are asking, where can I find income at a higher yield for maybe a lower to medium risk profile? And I mean, you could turn to dividend stocks. We already mentioned how valuations are quite elevated. That might be too much downside risk for someone to bear. Spreads are tight on bonds. You're not necessarily being compensated. So one of the areas that we've looked for an alternative source of income for clients is on the structured yield products. So specifically, our interest is found opportunity in contingent callable income notes or callable yield notes. Effectively, the best way to describe those are they're structured like a mutual fund. They're issued by the big banks. BMO, RBC, National Bank are three of the big banks that we use. And they're bond-like, but they also have an equity component. So you are prescribed a yield on the investment as long as, based on the performance of an underlying equity index. So the best way to give it is to give an example. RBC has a live note right now that provides an income yield of 9%. Now, you'll get that 9% yield broken down monthly as long as two things are true. One, in this particular case, the underlying basket of stocks returns better than negative 20% from the time you bought it. And in this case, it's the Selective Canada Blue Chip Index. Names like CIBC, TELUS, Bell, Enbridge, Suncor, those are all names within this index. And the second thing that needs to be true is the fact that the bank doesn't redeem the investment note. And the way they do that is there are prescribed intervals on when they can redeem or call these investments. And they do that based on the underlying performance. So the ideal situation for an investor buying that 9% note is that the index trades sort of flat to slightly negative, because then you're continuing to get your yield, you're still within that negative 20% protection barrier, and the note's not going to get called on you, and you're going to have to redeploy at another investment opportunity or for more at whatever the prevailing rates are.
And so something like a structured note, like if someone was trying to tailor their portfolio and think about all the different investments that can go into it, like what is the percentage of a portfolio that would be worthy of something like a structured note in your opinion?
I think 5% to 10%, depending on the risk profile of the client, of course. I mean, the two things remain the same regardless of what investment you're looking at. Am I being adequately compensated for the risk involved in that investment? And does it fit my risk profile and my time horizon? These are a bit different than money market funds or GICs in that the price can move because there is a secondary market for these. So you can actually sell them prematurely if you wanted the liquidity. But there's a good fit there for that additional income and as a complement to some bonds and dividend stocks that people hold.